What's up? This is Craig Smith with Precision Auto Lending. Today I'm going to discuss high interest auto loans and why exactly the rate of interest is where it's at on these loans. So I remember years ago, before I got into the car business and before I understood how bad credit auto loans worked, I used to wonder, why is it that people with bad credit would have a much higher rate of interest? Like, they already have a hard time struggling with credit. Why would you make them pay more? Just at the time, in my very naive mind, I didn't understand why, right? So I'm going to kind of explain today why high interest loans are the way that they are. So when lending groups pick up high interest loans, or I should say bad credit loans, when they pick up bad credit loans, they're going to charge a higher rate of interest. And depending on where the credit is, it could be anywhere from, 15 is the low end of high to as high as, I've seen loans at 35%. But a good average in the car business for auto loans with some rough around the edges credit is probably around 22%, right? You're going to be in the low 20s, maybe 25%. Not a whole lot are going to be above that. But the reason for the higher interest loan is because statistically, most of these loans are going to default. A good portion of them, depending on what type of credit we're talking about. But a good amount of these loans are going to default. And when they default, there will be losses. So the lender is going to lose more money than they got on these deals. So the way that they recoup on that is by having the ones that do perform at such a high rate of interest that it's like insurance on the loans that are not going to perform. So let's say they have 100 contracts, have 100 loans out, okay? Of those 100 loans, they have, let's just say, $1 million in principal owed to them on these 100 loans, okay? So that's how much they loaned, is $1 million. And of these 100 contracts, let's say 40 of them default in the first year or two, they're probably going to lose money on those loans, the ones that defaulted. So then it's up to the other 60 to perform at such a high rate that it can make the entire group of loans profitable, okay? So basically it's a numbers game, okay? And the way most of these lenders make their money on these deals is after a period of time, they will sell their contracts they'll wrap them in a big portfolio and they'll sell them, and then they'll get a fraction of what is owed to them on principal, and that's how the subprime auto loan business works, right? So when you're wondering why you're paying high interest, banks are assuming that most of the contracts in these portfolios are not going to perform as the contracts are executed. So that's why you pay higher interest on these loans. The key for a customer, and key for my customers, is, look, if you have bad credit, you're going to pay high interest. There's nothing we can do about that. But what we can do is we can create a situation so that you're only paying your high interest loan for a shorter period of time. Whether we go through a lease program or whether we trade and upgrade you in a short amount of time, because paying high interest for an extended amount of time is really burning money. We all have to do it at some point if our credit's not strong. Even first-time buyers come in and they're going to pay a higher rate of interest because they're a crapshoot. First-time buyer, they have an established credit. So at this point, the lender doesn't know what way that customer is going to end up, whether they're going to be a good credit or a bad credit customer. So they'll pay high interest as well. So that's just a little bit of high interest rates 101. Craig Smith, Precision Auto Lending in Las Vegas. We help people with some credit issues get approved. PrecisionAutoLV.com. Check us out at PrecisionAutoLV.com. Talk to you guys later.